including consecutive hikes in March, May and June. The conclusion here, Tom, we see hawkish risk in details of the upcoming FOMC meeting.
I'll wait for the data. It's amazing, John, the dispersion, I should say, not disparity, the dispersion of the different opinions and the sequence of opinions is extraordinary.
Let's get to Victoria Fernandez, the Chief Market Strategist at Crossmark Global Investments. And right on cue, Victoria, I'll quote you. I know everybody is saying that the Fed is way behind the curve, but I do believe that they were trying to follow the data, at least their interpretation of the data. What does that last bit mean, Victoria?
Well, I think, Jonathan, when we look, everyone has a different opinion of what the data means. Even just talking about the inflation components a moment ago, are people more concerned about the inflation number or the response to inflation? And so I think that's what it means. What is the Fed's interpretation of what we're seeing? Do they still see a transitory component, even though they took that word away because the market didn't like it? I think they do. They anticipate that the inflation number is going to come down, probably starting in the second quarter, and perhaps they want to buy themselves a little bit of time. So maybe we get one rate hike in March. I think originally they probably wanted to wait until June to do that. So maybe they'll give the market the first rate hike and then hold off until the middle of the year when inflation has come back down. So we need to see how the Fed interprets what's going on with inflation.
Victoria, what's the sweat level out there? When you talk to Crossmark clients, how afraid are people? Is there any sense of catharsis out there in abrupt change in equity portfolios?
Well, obviously, when we've seen some of the volatility over the last couple of weeks, that's made clients nervous, right? But our conversation with them is, look, there is a lot going on right now for the market to digest. We have a decently strong economy. Hopefully, earnings is going to continue to support that. But you go along with it, we do have some high inflation numbers. We have monetary policy we're trying to get through, and we have rich valuations on some of these stocks out there. So the market's trying to digest that. It's not surprising then that we're in like the lowest decile of stocks making 20-day highs. But I think what's important and what we tell our clients is look at this kind of oversold condition that we're in the longer term upward trend that the market is still in, and combine that with the fact that credit spreads. Jonathan and I, we talked about this on Real Yield about a week ago. Credit spreads are so well behaved right now that tells us there's still some support for the equity markets. There's just going to be quite a bit of volatility.
I love that you have John has embedded a plug for his Real Yield show into his guests that come on this property. Thank you for that. That is a fantastic show. I do recommend you watch it 1 p.m. on Fridays. Victoria, how much going forward do you think that we have priced in some of the potential margin compression as we deal with the inflation that you talk about?
Yeah, I mean, this is what everyone's going to be looking at in these earnings reports that come out. I mean, this week is jam-packed. You were naming some of the companies that we're going to see. The biggest issue that we think is going to be margin pressure when it comes to wages and employment cost index. Look at the ECI and how high that number has run. I think the Fed is watching that very closely. JP Morgan's an excellent example, talking about the issues that they had in regards to wages going higher and what that did to their earnings. So I think that's going to be key when we're looking at what the earnings report tell us and the guidance. Obviously, there's going to be some supply chain issues that will cause some margin compression as well. But I think it's going to be the employment cost that really people are going to be watching. And that could make a difference when we're looking at the volatility throughout the rest of earnings season.
So, Victoria, given this whole backdrop, the fact that you said that you're looking at an oversold condition, what aspects of the market right now are oversold and look attractive given all of these risk factors that you're putting out there?
Yeah, you know, Lisa, look, the average stock is down about 15% right now from its 52-week highs. Tech names even more so, around 20%. So we think people need to pull out their shopping list here. We like financials as a sector for the 2022. We like JP Morgan, we like Bank of America, but I think look at some of the pullbacks that you've seen in other names, some of those more cyclical value names. Lowe's is down 11% over the last month. We just added to our Lowe's position on Friday. Regions Financial is another name. Tractor Supply, I think, was down about 10% over the last month. So I think look for individual names that you can add to your portfolio that have had that pullback and start checking them off your shopping list.
Victoria Fernandez at Crossmark. Victoria, thank you for joining us and, of course, for the plug as well. I appreciate it.
How much you
know
pay
that. Victoria, thank you
pleasure.
very much. It's free. Come on, Lisa. Just a great show. It's a
So
great
good.
show. This is a theme of this morning so far. What's the biggest risk right now, inflation or the response to it? Last year was clear. It was inflation. And once you identify the biggest risk, you can kind of think about how to hedge it. So last year rather, inflation. How to hedge it? Well, people flooded into tips, didn't they? This year, Bob Miller of BlackRock, Tom, he talked to me about hedges for 2022. I said, okay, well, what is the hedge right now? We're short tips. Real yields are going higher. What does that tell you about what the risk is right now, Tom? Last year, it was inflation. This year, it's the response to it. That seems to be where people are leaning towards.
How much have we already had this in? We're for 3 or 4 weeks into this exhausting year. How much of the move has already occurred? John, I'm glad Victoria brought this up. I just looked at what's called the Depot Drawdown. This is the decline of Home Depot from the peak, and it's down 16%. I don't think a lot of people understand. You know, she mentioned Lowe's. I don't think a lot of people understand this.
And some massive names as well in a tech space.
You like that,
Tom.
John? Depot Drawdown?
I do like that. It works.
You can steal that for your other properties.
I will borrow that for the 9 o'clock count.
Yeah, please.
TK, you mentioned how much of the move we've seen. 10-year real rates, Lisa, have gone from negative 120 to negative about 60 very, very quickly.
And what's driving that? It's not necessarily 10-year yields shooting higher. It's the fact that longer-term inflation expectations are coming down. Is that the policy response, or is that inflation acting as the best way to kill off inflation by slowing growth?
Break-evens are coming in. We're going to talk about this in about 25 minutes. Tom can't wait. Tom King, Lisa Bramwitz, and Jonathan Ferro.
Oh, dear Lord.
Is this 2021?
Take it back to the depot.
Futures down a third. On the S&P, on the NASDAQ, down 0.5%. Are you having vintage Tang?
It's dated Tang. I don't know. I need fresh Tang.
Aged Tang.
Okay. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden reportedly may drop the U.S.'s restrained stance on Russia and Ukraine. According to the New York Times, the president is considering deploying warships, aircraft, and several thousand troops to NATO allies in Eastern Europe and the Baltics. There's growing concern that Russia will attack Ukraine. British Prime Minister Boris Johnson faces his most crucial week in office. Johnson is bracing for the outcome of an investigation into reports that he allowed drinks parties in Downing Street, which broke pandemic rules. The results of that probe could lead his Conservative Party colleagues to force him out. In Israel, a new study says that a 4th vaccine dose for older adults leaves them better protected against coronavirus infection than peers who received 3 shots. Researchers found that those with 4 shots had twice the protection as the others. The great majority of people in Israel has received the Pfizer vaccine. An activist investor is adding to the pressure on Unilever CEO Alan Hope, who failed in his bid to buy a consumer health unit from GlaxoSmithKline. Bloomberg has learned that Nelson Peltz's Train Fund Management has built up a stake in Unilever. It's unclear what Peltz's intentions are. He has a history of pushing for changes at consumer companies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
lot of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
I think our work in the Senate and President Biden's work to strengthen deterrence is what is hopefully going to succeed. But I am gravely concerned that Putin will show once again aggression in Europe and cross the boundary into Ukraine in the coming days or weeks.
That was Senator Chris Coons there, speaking to ABC. From New York City this morning, good morning. Tom Keene, Lisa Brabbits and Jonathan Ferro. Your equity market has a bit of a bounce on the S&P, but not much of one. The Nasdaq still lower by 0.5%. The S&P 500 is down a third. Yields are lower by a couple of basis points on 10s to 173.51. The focus at the moment, Tom, as you know, we're counting down to that Fed decision, also focusing on what happens now between Ukraine and Russia. Last week in that news conference, the president gave the impression that it was inevitable that the Russian President Vladimir Putin would do something. What? We don't know. The UK Prime Minister Boris Johnson, Tom, in the last couple of moments saying a Russian invasion of Ukraine is not inevitable. I think that's an important line from the Prime Minister this morning, Tom. An invasion of Ukraine by the Russians, not inevitable.
Well, everybody is managing the message, and certainly Mr. Johnson is not giving a 2-hour press conference where you get into trouble. John, what do we make of Ukraine? Could be the new Chechnya over by the Caspian Sea and the two wars of Chechnya for Russia. Ukraine could be the new Chechnya for Russia.
What's the impression there, Tom, that this is something you get bogged down in and you're in there for a long, long time?
Yeah, I think that's a basic idea, but also I think we're learning the geography and the history here. We can do that. Emily Wilkins in Washington with a brief from Washington, and again, joining us is in the last hour, Maria Tadeo in Brussels as well. The distance from Kiev to Gorky, I think it is, Chechnya, I don't know what that distance is, but to me it's another time and place. Maria, what is the collective memory that Mr. Putin has other than Crimea, where, let's be blunt, he was successful? Is it a sum of memories for Putin, or is it just, I did it in Crimea, I can do it in eastern Ukraine?
Well, you know, if he's thinking, I did it in Crimea, I can do it again in Ukraine, there's one big important thing that he may be forgetting and not factoring here, and that is, since the annexation of Crimea, there is this fervent national sentiment in Ukraine that this is a country that they want to protect and they want to really push away from the Russian sphere of influence. If you ask me, and this is the reporting that we've done behind the scenes, also speaking to Ukrainian officials, to me it's crystal clear that Ukraine will fight, they will put up a fight, and the country right now is really prepping for war, and they believe that this is something they want to do. Ukraine tried 5 times in its history to separate and break away from Russia. They were able to do it after the Berlin Wall, and they know that this time around they will fight again. And sometimes I do wonder if this is something that we are not factoring enough in the conversation. Ukrainians will fight in this war.
How do the French and the Germans respond to the idea that Mr. Putin would put in a new government in Kiev?
Well, you know, that's the big point and the big question right now, that Paris and Berlin are not on the same page, and that's why there's a meeting tomorrow, by the way, between Emmanuel Macron and Olaf Scholz happening in Berlin. What I would say, however, is that this really is decision time for Germany. We know that whether there's an invasion that's military, or whether we see cyber hacking or any other form of political destabilization happening in Ukraine, the Germans are going to have to finally make a decision. They didn't do it for 10 years under Angela Merkel, and in fact, many would now tell you the issues that we're seeing right now, it's the failure of the politic of appeasement that Angela Merkel carried out for 10 years.
Emily, from the United States' standpoint, what's the main motivation for being involved, for having red lines, for really countering Russia if that red line of invading Ukraine is crossed?
I mean, the U.S. is actually, the conversation in Washington right now is more about what the U.S. needs to be doing before that line is crossed. If the U.S. should be either putting forward troops and sending more assistance, sending more weapons, already beginning sanctions, not waiting for Putin to make the first move, but showing that the U.S. is willing to act by starting that action. I mean, you heard from Senator Chris Coons in that early clip that he's a Democrat, but you've also heard similar sentiments from Republicans. Last week, before they broke for recess, they were talking about having legislation, moving forward a package that could contain potential sanctions and how they would get the bipartisan support for that. You've seen the House also take an interest in that. The only thing now is that they're gone for this week. They're back in their districts. They're talking with their constituents. They're not in Washington getting something done, which means that if Putin moves within the next week, the U.S. might wind up being caught flat-footed.
But Emily, what's the main motivation for this administration? Is it to fortify the alliance with Europe? Is it to fortify access to certain precious resources, whether it's natural gas or whether it's lithium, which is in the region? Or is it to counter this nexus of China and Russia that seems to be increasingly close as they try to go after the same resources?
I mean, Lisa, I think you've nailed hit the nail on the head in all of those instances. These are all things that are really motivating the U.S., as well as just simply standing up for other democracies, trying to limit Russia's influence in various sectors of the world, and trying to send a signal to countries such as China that, hey, if you try to invade other democracies, we will stand up, there will be a response, and it's not something the U.S. is just going to sit back and let happen.
Emily Wilkins in DC and Marita Dao out of Brussels. Team effort, transatlantic. Thank you very much for joining us. Tom Keane, it feels like things ramped up over the weekend. You saw the removal of family members of staff of embassies for the US. Germany followed. Looking at headlines coming out this morning, Tom, it seems they're preparing for tensions to ramp up again.
Yeah, and the tape just moments ago giving way here. NASDAQ futures down 0.7% as well. John, I go back to the singular headline for me of the Blinken press conference was the reaffirmation of NATO open door policy, open door with all that baggage of 20th century foreign relations. John, I don't know how Europe enunciates open door policy other than to support Ukraine. To me, there's not a choice set here. There's not a debate. Open door policy means complete support of Ukraine.
That open door, Tom, though, open, yes, the Russians would like it shut for Ukraine. But Tom, even if it is open, can Ukraine walk through it? And I think we have to talk about the probability, the likelihood of that actually happening. And when you listen to the reporting on the ground in Europe, the likelihood of that happening anytime soon, pretty low, Tom.
Well, yeah, and then it goes back to the hydrocarbon story. I mean, I don't care if it's July or it's January. There's always going to be, in the back of it, the reliance on Russia for the marginal barrel or BTU of gas.
For Russian gas, Lisa, that's where the tension has been over the last several months. That's where it is still.
And that's why I kept focusing on the resources rather than democracy building, because frankly, this administration and the previous one really moved away from that. How does that cater to U.S. voters, this idea of intervention internationally that kind of lost favor? So how do you dovetail the Afghanistan policy with this one if you do take a more aggressive action?
It's time to get through this week. This, of course, is a huge focus worldwide. Then we have a Fed decision on Wednesday. Some Apple earnings as well, Tom, in the mix too.
Yeah. John, very quickly on pound sterling, Jordan Rochester Nomura suggests 132, a short on sterling.
Interesting. Euro dollar right now, 113, negative a third of 1%, very close to breaking into the 112s again. Equities down a third on the S&P, on the Nasdaq down a half of 1%. On radio, on TV, this is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance. As you were, from last week into this week, the pain continues. Futures negative, 0.6% on the Nasdaq 100. On the S&P, we're down about a third. Last week, over just 4 trading days, down more than 7%. On the Nasdaq, down more than 5% on the S&P 500. It has been that ugly, the worst weekly loss going all the way back to the depths of the pandemic. In the bond market, that's where some of the pain has come from for much of this year. Yields on the year still up by a little more than 20 basis points on a nominal yield. I stress nominal. I'll get into why in just a moment. 10-year nominal yields right now down 2 basis points to 173.33. Up on the year. Last week, though, they didn't do much at all. That's important. So you had all that pain in big tech, but nominal yields didn't do much at all. So let's talk about this. Switch at the board, and we're going to have a sneak peek of a chart of break-evens. What are break-evens? So you subtract the yield on the inflation-linked curve from the nominal yield of the same maturity. So look at real yields, and then you get the implied inflation rate for the market, so-called break-evens. Break-evens have been rolling over, and they rolled over last week too, even though nominals didn't do much. So what happened? Real yields were pushing higher. Tom, this is really, really important when we talk about the biggest risk right now. Last year it was inflation. This year, people are starting to think about the response to it. Last week wasn't a move on nominals, it was a move on reals, and break-evens rolled over. That's really, really important to bear in mind when we start to think about the dynamics underpinning this mess in big tech.
Dynamics is on economic growth, John. We'll just have to see. Yes, we've got the tech earnings this week, but maybe that's history, and the real issue is going to be the economic growth.
Looking forward to the data as well this week, too. The ECI, Lisa, taking on some renewed importance, I'd say, after what Chairman Powell said in that last news conference.
Especially at a time of earnings where margin compression seems to be the big question. Some saying we're going to see it, and others saying they can still pass along the prices to consumers.
Kelsey Barrow of JP Morgan Asset Management making that point last week. I thought it was a really, really good one. The ECI in focus at the back end of this week. Got to get to the Fed first. That's your cross-asset price action. Let's get you some single names this morning. We can say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Tech stocks are weaker here in the pre-market. A few of the bright spots here are related to sort of activist investors here. Kohl's shares right now up about 26% here. This based on Bloomberg reporting that at least a $9 billion offer is on the table from Acacia Research backed by Starboard. And there's a second offer apparently in the works now from Sycamore. We don't quite know what that deal is worth here, but Kohl's is in play. Remember, activist investors have been kicking the tires on this company now for at least the last 2.5 years. Some of the other department store stocks like Macy's and Nordstrom's each up about 5% or so here in the pre-market. And speaking of activist investors, keep an eye on Peloton. The knives are out right now for Peloton and its CEO, John Foley. Blackwell's put out a pretty extensive letter here making the case for why not only the company should get rid of Foley, but why they should consider selling the company here. No response yet from Peloton, but of course, we've got an 80% drawdown on those shares right now. We should point out that Foley, who's the co-founder of the company, has an inordinate amount of voting power here, so it's unlikely here that Blackwell's would have enough clout to force anyone out on its own. Those shares down 1% here. Flip up of the board here. We are keeping an eye on tech stocks. Netflix, which of course had that massive loss on Friday, down about 22%, down another couple percentage points here in the pre-market. That's the risk sentiment right now, at least as far as it comes to the tech stocks. Apple down a couple percentage points this morning. Snap shares setting up for an 8th straight day of losses, down 5%. And Tom, we got to talk about Bitcoin re-earning its moniker BitDog. Right now down about 50% from that 67,000 peak that we saw back in November. Basically every stock tied to the cryptosphere right now, lower here in the pre-market, including Coinbase, down about 9%.
We'll have team coverage on Bloomberg Radio, 10 a.m. this morning. Matthew Miller and Paul Sweeney will dive into the Bitcoin morass. Romain Bostic, thank you so much as he prepares on the close for tech earnings this week. In the last moment, Swiss franc out to new strength. Some of these indicators of global tension. NASDAQ futures negative 0.7% is something I'm looking at as well. It is a most wonderful time to speak to Terry Weissman. He's global interest rate and currency strategist at Macquarie, but with decades of experience at understanding that the Fed is a central banker to the world. Dr. Weissman, what I want to do right now is take the really important comment in your recent research that the Fed is far more important than Omicron and the Ukraine as well. If that's the case, what does EM want from the central banker to the world?
I think emerging markets want what they always want, which is cheap liquidity flowing from the developed markets into the emerging markets to help sustain their asset prices and sustain their growth in their financial system. Unfortunately, we're probably not going to get that easily when the Fed is retracting liquidity. And this is not really unusual. When the Fed starts into its a tightening policy from an accommodative policy, as we saw in 2013 with the taper tantrum, as we saw it in 2015 in anticipation of the first rate hike from the Fed, there's always a class of assets that does poorly. In 2013, during the taper tantrum, it was clearly emerging markets, but you had a rotation in 2015 into the asset class that did most poorly, being commodities. There's always an asset class that suffers. It may not be emerging markets this year, by the way. It may simply be that class of assets that's done very well in the previous regime of easy monetary policy and the pandemic, which was large cap tech. That's why we're seeing money coming out of the NASDAQ 100 and the cryptocurrencies right now.
The arch theory is that EM is stronger, better, more resilient than they were 20 or 30 years ago. Do you buy that?
I would have bought it if you asked me that 2 years ago. The problem is that the pandemic has introduced certain structural weaknesses into the emerging markets, including high debt levels. Remember, the emerging markets were no less shy than developed markets in trying to spend their way out of the problems of the pandemic. That's left them with a high level of debt, a high debt burden, just as it has for the developed markets. So that thesis might have been valid 2 years ago. It's hardly valid these days.
So Terry, why have we not seen more of what you expect from the Fed priced in if we have one house after another coming out trying to up their forecast for the year to 5 rate hikes or possibly more?
Well, if you mean for the emerging markets, I think it's because they were never a beneficiary of what happened over the last 2 years, certainly not from a structural or economic perspective. So there's a thinking out there that because there's so much more value, relatively speaking, in the emerging markets versus developed markets, they should be rotated into as we move out of the old regime and into the new regime. Now, that might be valid, except for the fact that I mentioned that some of these emerging markets do have these structural issues now as a result of the pandemic. But let's face it, some of the issues that are burdening the world and the sentiment of traders right now are stemming from the emerging markets. Russia is clearly an emerging market. China is as well, and there are geopolitical tensions there too with regard to Taiwan. And of course, Latin America, the other bulge bracket emerging market, is confronting a lot of political issues this year, including 2 major elections. So yes, if it weren't for the structural issues from the pandemic, if it weren't these geopolitical concerns, yes, Latin American emerging markets generally would look cheap right now. I agree, but there's still a few headwinds.
So give us a sense of the scope of dollar strengthening that you're expecting.
So we're expecting a little bit more dollar strengthening over the next few weeks and months. I mean, until we get resolution from the Fed as to what it's going to do this week, and especially in March, it feels very difficult to imagine traders jumping back into foreign exchange and abandoning the dollar. So I think for the next few weeks and months, we're going to continue to see that strong, sturdy dollar theme that we've been advancing and calling for since the middle of last year. I think when we get through a few hurdles, including the Fed's hike and the clarity over what their interest rate outlook is, we get through the French elections, maybe we get through the Russia-Ukraine issues, then we can expect some dollar weakness, but it probably won't happen until well into the second quarter of this year. We need to get through all of those hurdles.
Tell me of China and the state of it now, Terry Weissman, going into the Olympics, days away, and then out of the Olympics. What happens when we go home?
I don't know. Are they going to invade Taiwan? Are they going to continue to pump more liquidity into the system? Is their property development sector going to crash as a result of the burden of debt?
Can they manage it? This is your wheelhouse, Terry. Let's go there. I don't mean to interrupt, but this is too important. Do you suggest that their government can bail out the real estate sector as in the way they've bailed out things over the many decades?
Yeah, there are very few financial sector problems that enough domestic liquidity created by the central bank cannot solve. Okay, let's be very clear here. On top of that, China has some certain advantages when dealing with these financial sector issues. They control the state banks, for example. They control a lot of the economy. So I think the tools at their disposal are actually greater than the tools that might have been at the disposal of the U.S. in the global financial crisis of 2009. So yes, I think that there is. I mean, if you have to bet whether or not they're going to be able to solve this, I would say yes. It may not be an abrupt solution. It might not be immediate, but over time, I don't think it's going to lead to the kind of concerns that we saw 11 or 12 years ago in the Western world.
Terry Weissman,
without housing crisis.
Macquarie. Terry, thank you. Some really, really important points. And Tom, I think at the end there, the message is clear. China has space to move and ease a whole lot more.
Yeah, we're going to have to see. And I, not that we're up to speed in the Olympics. We're not going to Beijing, are we, John?
We're not, Tom.
Okay.
I can confirm that you and I are not coming to the Beijing Winter Olympics.
I'm okay. I'm like, okay, the Olympics and their X number of days, and then what? And that could be a complete overlay on the other tensions. We're seeing, John, it's Javier Blas. He's the one that does it. And Lisa and I are oblivious to this, folks. Thanks, Con Ed, for stable utility prices. John, Javier Blas, moments ago, out with a spectacular chart showing energy prices in Europe led by France and Germany, if my map's correct, with very high prices.
And Tom, this raises the question just how united the Europeans are, the European members within NATO, how united they are on any potential response to Russia.
Well, yeah, I mean, the United here has got to come together. I mean, am I wrong, John, to say that United will happen under crisis events? I mean, that's usually the way it goes.
Tom, that's the hope, but where does the leadership come from? There's been this talk for a while that Germany and France together, this German-Franco leadership, will emerge on foreign policy, and it hasn't happened, Tom. Within NATO, it's still the UK leading the way.
Stronger Swiss franc.
It's out there. Tom, if you're on radio, you needed the TK count. You did. When you get back home into the office, you know where we are. Yields in a couple of basis points to 173 on 10s. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. State Department is now warning of what it calls the continued threat of Russian military action in Ukraine. It's ordered family members at the embassy in Kiev to leave the country. An advisory says that security conditions are unpredictable and can get worse with little notice. Meanwhile, the New York Times says President Biden is considering deploying forces to Eastern Europe and the Baltics. President Biden's chief medical advisor says the U.S. Omicron outbreak is headed in the right direction. Anthony Fauci told ABC News the surge that has pushed COVID infections and hospitalizations to records will peak soon, but he says that decline will not be uniform throughout the country. And that sell-off in cryptocurrencies gained momentum today. Bitcoin lost more ground and fell below the $34,000 threshold. It's now down more than 50% from its all-time high back in November. Crypto has come under widespread selling pressure in recent days. Traders point to those hawkish signals from the Fed as a reason to withdraw from risky assets. KKR has agreed to buy Dutch bicycle maker Axel Group for $1.8 billion. The pandemic has spurred a cycling boom, and Axel shares have more than tripled in less than 2 years. The company owns brands such as Sparta, Hercules, and Raleigh. Bloomberg's learned that an activist investor will push Peloton to fire its CEO and try to sell itself. Blackwell's Capital has less than a 5% stake in the fitness company. Peloton's shares have plunged more than 80% from their all-time high a year ago. That's concerned that the easing of pandemic restrictions will slow the company's growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick is invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. That we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
You have a story of supply that is frankly terrible. The labor market is shrinking for the first time since World War II, and you exclude durable goods, you haven't had capex. So I take issue with this idea that it's all about strong demand, booming demand, that's why the Fed's hiking. The Fed sure will have to hike, but there's also bad things happening in the background.
The view from George Saravelos there of Deutsche Bank, the global head of FX research, with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Bramo's opinion piece over the weekend getting a ton of attention. Lisa, Wall Street's big payday makes the Fed's job harder, and you quoted Saravelos in that piece.
Honestly, it seems like there was a narrative early on in the pandemic that the lowest income individuals were seeing the biggest pay gains, which was true, and that's shifted. And we really saw that in cold relief over the bank earnings last week. How much does this shift the narrative? We're also seeing that in anecdotal and frankly, hard data. If the poorest of the United States really are still suffering the biggest real wage losses, how much does this complicate things for the Federal Reserve at a time when that really complicates things, frankly, for President Biden?
You can find Lisa's writing on Bloomberg Opinion, on Bloomberg.com, and on the Bloomberg Terminal. And I wasn't paid, Lisa, to do that.
Well, you know,
it's just out of love.
I'll do the real you promo.
You've done that already. That was me just getting even.
Thank you.
Futures down 23 on the S&P 500. We're down 0.5%. Let's whip through this together, TK. The Nasdaq 100 rolling over. It's negative 0.8%. Last week on the Nasdaq 100 was ugly, down 7.5%, the biggest week of losses to March 2020, and we only needed a 4-day week. In the bond market, this curve is a little bit flatter. That means that the front end yields are a bit higher by a basis point, and at the long end on 10s, we're down 2 basis points to 173. So just above 70, the spread between 2s and 10s right now. That spread is getting narrower, that curve is getting flatter. In the commodity market, we're down 1/3%, let's call it a quarter, 84.91, it's a break of 85. And Tom, in the FX market, a ton to get through.
Well, you have to. Euro just broke down off Switzerland. Switzerland out to new strength. This happened moments ago. Folks, this is what people do with a Bloomberg terminal when they're in crisis. And I'm not saying this is crisis, but I'm looking on the screen, John, at new weakness, Euro Swissy. Dollar ruble's almost out to new weakness there, moving towards an 80 weaker ruble level. And the Bloomberg Dollar Index, John, speaks volumes with the good mathematics of EM as well. Oil's come back a little, John, but we're at a point now where my deepest market is foreign exchange.
What do you make of the ruble move, Tom? Over the years, over the last 5, 6, 7 years, life above 80 has been difficult for that currency pair. Very close to breaching it again.
First of all, Russia's a much smaller economy than people think. So it's a very odd thing. There's 3 series people look at, John. Euro ruble, a ruble basket, and dollar ruble. And time after time in crisis, people go back to the relationship to the U.S. dollar, and it shows a new weakness. Swiss franc is stunning, John.
Oh, that chart of Euro Swiss is unreal, not just over the last month, but over the last 12 months. And it's going in one direction. It's just rolling over. I caught it with Kelsey Burrow of JP Morgan Asset Management on Friday, Tom. Asked a very simple question. Can the ECB sit out the rate hiking cycle over at the Federal Reserve this time around? They did last time. Can they do it again? She does not think so. Works alongside Bob Michael, Tom.
Right.
They think we could get a rate hike from the ECB later this year, perhaps in December. I imagine the Swiss would love to see it.
We're going to get a 31 print on VIX as well. Right now, to advance forward the foreign exchange discussion amid all the news flow that we have this morning, Kriti Gupta on BBDXY. Kriti, what do you have?
Yeah, Tom, we got to talk about, of course, this equity correction, but what actually reverses it? If you look at the last, say, 3, 4 corrections, which, by the way, in the last 3 years, you've only had 4 corrections in the equity market. 2 of them were actually spurred by Apple hitting those trillion-dollar milestones. It makes sense. Big tech leads the stock market to the record highs. It also brings it down. But what reverses those big corrections? So I did some math, I did some digging here, and it turns out that those buy the dip moments tend to be driven when you start to see a weaker dollar. It really tells you that those foreign investors tend to buy the dip first before domestic investors. And this actually is kind of in tune with what you've been hearing in 2020 and 2021, especially in the last quarter of 2021, where you did see that growth bid kind of taper off just a little bit. And a lot of that has to do simply because the buyers, they just weren't there, Tom.
In your weekend reading, what stuck out? What was the research piece where you said, wow, this is interesting?
I'm always going to stick to commodities. I think the commodity story, especially when it comes to the Middle East, is fascinating right now. We're talking about the UAE, Saudi Arabia in particular, being the only 2 countries to be able to ramp up that oil capacity, and yet there are reports that the UAE is already dealing with some really significant attacks from the Houthi rebels. So to me, that's the story that really stands out.
And Kriti, building on that, Goldman Sachs had a note over the weekend talking about wargaming $150 a barrel with respect to Brent. What would that look like in terms of the global economic hit? Do you hear more aspects like that, more analyses from analysts who are getting increasingly concerned about the upward pressure here?
Well, the problem is perhaps they're not getting concerned enough, Lisa. The issue is that the kind of supply dynamics, the assumption that is built into the market right now is that the pump can flow, that there will continue to be this oil supply. I don't think a ton of people have priced into the market what happens if you do actually hit oil, see oil hit not just $100 a barrel, but cross that. Of course, that isn't the consensus on Wall Street yet, at least for 2022, but it could very quickly become a risk. Once again, like I mentioned, those geopolitical tensions, but then factor in the Russian-Ukrainian conflict, where you do have those natural gas flows actually affecting geopolitics and affecting the currency, affecting the CDS. That's really where the issue lies. Say that you don't have Russia on your side, you're starting to have UAE output potentially threatened. That's a strong phrase right now, but potentially threatened. And of course, you don't have U.S. shale producers on your side either. So where do you get supply at a time when the global economy is really growing?
Kriti, thank you. Kriti Gupta on the latest. Tom, I have to say, go back to early 2020. Do you remember that January? At one point, we were going to war. Not joking about that. It felt that way at one point, didn't it? This start to 2022, 3 weeks into it, this is the longest month in quite a while, Tom.
It's a long, yes, I will agree with that, John. And this is was we get the VIX out to 31 within the more prosaic U.S. equity markets. But the spike down here, John, in strong Swiss franc against euro, a lower statistic is a stronger Swiss franc is really extraordinary. I don't know if we've got the granular Bloomberg chart here on EUR-CHF, but yeah, I mean, it's really come down here, John, on a sudden movement. That bears watching. Moscow just emailed me on the CDS, Russia CDS. I'm usually, John, John, not a fan of measuring by CDS because it's not nearly as deep a market. But for ruble to go to new weakness would be something.
You can take Euro Swiss intraday, Lisa, take it over the euro as well. It's basically the same chart. It's rolling over. I mentioned this a little bit earlier this morning. For the S&P, the Swiss National Bank, negative 75 basis points on a policy rate at the moment. They can't do anything about this.
At the same time, if you talk to currency strategists right now, it doesn't seem like rate differentials really is driving a lot of the currency activity at this point. It really is more economic momentum. And given the fact that you've got the dual threat of not only the pandemic, but also the Russian potential invasion, it's concerning for the euro region.
We're moving so fast here. I misspoke. Ruble has just gone to new intraday weakness.
Are we through 80 yet, Tom?
No, we're at 79.48.
If you take that chart back to 2015, you'll see the spike through 80 again and again. Very, very difficult to stay above those levels. At least recent history has shown it to be that way.
That's what we're going to do here, including on the open at 9 a.m. We'll continue this discussion.
David Riley will continue the discussion as well of Blue Bay Asset Management with Tom Keene, Lisa Brabbits and Jonathan Farrow. Your equity market down 0.5% on the S&P. On the NASDAQ, down another 0.8%. Loss after loss after loss after loss through last week, and losses again this morning. On radio, on TV, for our audience worldwide, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
market is near oversold territory.
I think the outlook for the balance of the year is a bit more constructive.
Even as we're in a pandemic, we're still seeing an extraordinarily strong picture.
Profit matters a lot, and I think multiples matter a lot. Balanced against that, growth matters a lot.
It's going to be a market where people have to have a slightly longer-term view and ride through.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Markets on the move earlier, ever more so as we begin the 8 o'clock hour. John Farrow, the VIX through to a 31 print, and all the tensions in Europe showing up in equities, in bonds, in currencies, and commodities.
We're breaking down a bit here, Tom. The S&P 500 down 0.7 on the Nasdaq 100, down more than 1% now. You've heard the calls coming from Goldman, from Deutsche Bank. It's Citi joining them this morning. The risk this Fed has to do more. That's where the focus will be for a lot of people going into Wednesday.
The significance here profound on weaker ruble, I should say, and stronger Swiss franc, and it shows out a new strong U.S. dollar. Seems like the market may be doing some of the Fed's work.
Classic haven flows, Tom, going into the Swiss franc, and the underperformance pretty clear. Look to Europe, the equity benchmark in Frankfurt, Germany, the DAX, down more than 2 full percentage points. Tom, we've got the tension over higher real rates here in the United States, smacking around the Nasdaq last week and into this morning, and we've got the tension in Europe with Russia and Ukraine, really weighing on European equities a bit more as well, Tom.
If you're just joining us on radio and television worldwide, we are hearing leaders speak. Boris Johnson in the last hour commenting with some very strong language out of London. Lisa Abramowitz, we await comments from President Biden.
Yeah, he's going to talk later not only about the Omicron variant and what the potential testing will be, but more about the fact that you're seeing prices go up and real wages, real income go down. What do you do with that? To me, the question is, are we seeing a longer-term expectation for growth slowing because of inflation or because of just something that's done? And this is what John's been asking all morning. But I keep looking at inflation itself and sort of feeding into some of the margin pressures that people are expecting and seeing in the forecasts. How much is that alone, regardless of what the Fed does, really what's driving some of the action, Tom?
Well, that's the economic standpoint here. And again, I've made clear I'm looking at the growth ballet. We'll have some good guests on that. David Riley to join us in moments. But John, later in this hour, our conversation with the ambassador of France to the United States. It's been Germany, Germany, Germany over the last 3 days. You wonder how France fits in to Eastern European calculus.
How united, Tom, are those European members of NATO? I think that's what you're trying to get your hands around this morning, and that's going to be an important conversation later this hour.
We're going to have to see. Futures negative 33. John, again, I'm going to print out 30 out to a 31 VIX. We've basically moved from 21 to 31 VIX in good order, showing the fear in the market. John, what do you see this morning?
Curve flatter, Tom. Down 2 basis points on 10s to about 173.51 on 10s this morning. Nasdaq futures lower by more than 1%. This has moved really, really quickly. We've gone from this conversation about the fears, the risks around higher inflation. Now we're talking about the policy response to it, and some people are going the next step. They're worried about a slowdown in economic growth. Now, think about how we closed out last year. We were talking up 4% real GDP growth in America for this year, and now all of a sudden the conversation has gone from inflation to a Fed response to it to slower growth and a Fed hiking into weakness. That's how quickly things have moved, Tom, and to be honest with you, I can't keep up. I'm not still totally convinced that Fed leadership has got away from the essence of transitory, even if they've got away from the word itself. I still think that the chairman believes that by the middle of this year, inflation fades. So for all this talk of the risk of the Fed doing more, I hear it. I see that's the consensus now, but I think it's a really important meeting for this chairman. Is this a chairman who is about to try and break the back of inflation, or a Fed chair who believes that this inflation story from Q1 on is going to fade? Yes, they have to tighten, but maybe, in his mind, they won't have to do much.
John, I think they're data dependent. That's all there is to it. And to your good point, we're, center tendency, 4% growth, double-digit China-like growth down to 4% growth. We don't know where that growth is right now. We certainly don't have the ability to do a terminal value.
We can make some basic calculations, though, Tom, as far as inflation is concerned, just year over year. Just really simple. You can see where the tension is going to come from for the next 3 months into the end of Q1. That much is clear. From then on, going into spring and into summer, the base effects, Tom, get that much harder. The hurdle is that much taller. There's an argument there, probably going to get some abuse for this, but there's an argument that inflation should fade from Q1 onwards.
John,
Steve Englander of Stan Chartered shares that view.
Before we get to David Riley and move on here, John, an important headline from the Bank of Russia. they suspend foreign exchange purchases to reduce ruble volatility. It seems that 80 point you mentioned, John, is awfully important.
Historically, in recent history over the last 5-6 years, dollar ruble, life above 80, Tom, hasn't been sustainable. We're very close to that level again.
Let us get to it. We are thrilled to bring you to Start Strong David Riley, Chief Investment Strategist at Blue Bay Asset Management. He got out from under the desk to join us this morning. David, what are you doing right now given the cacophony of economics and international relations?
Well, right now, I think it makes sense to be reducing risk, and that's something that we've been doing across several of our strategies over the last 2 or 3 weeks. And the way that we've been doing that to some extent is booking some gains that we've made on short US duration positions, reducing the sort of level of credit beta that we have in our credit strategies, increasing some of the holdings of cash that we have. This isn't because we're fundamentally bearish in light of the discussion you've just been having in terms of the economic outlook, but we do think that there has been this kind of disconnect between the messaging and the expectations around tighter Fed policy and financial conditions. And I think what we're seeing now is kind of financial conditions starting to sort of catch up with what the bond market has been saying in terms of the outlook for the Fed.
David, when you hear the likes of Deutsche Bank, Citi, Goldman talking up the risk of doing more, and the base case is 4 hikes and balance sheet reduction, the risk of doing more on top of all of that, David, you start to think about leaning the other way then?
Well, I think there is a risk, the Fed does more than is currently priced. I mean, it's been our sort of baseline for some time that the Fed was behind the inflation curve and therefore would want to catch up, and we're looking at least 4 rate hikes during this year. And on estimates, if you add in the quantitative tightening, which I don't think the market has yet fully kind of priced in, then that could be, another 10 to 20 basis points worth of tightening in this year. In this year alone. So I think the point where you start kind of lead the other way is, I think if we actually saw, for example, because of concerns around Russia, because of concerns around the sort of volatility within risk markets, we saw 10-year Treasury yields, heading back down towards sort of the 160 level. I'd actually want to sort of re-engage and go short at that level once again.
Going forward, the Fed is going to talk about both the balance sheet reduction as well as the rate hikes. And you said you expect $2.5 trillion, basically, more or less, of reduction this year and next year. How should that be priced? And I'm not just talking about in equities, but also in credit.
Yeah, it's a good point, Lisa, because I think one of the issues and the concerns that I have is with this disconnect between financial conditions, and which are still extraordinarily easy, and the path for Fed rate hikes, quantitative tightening, and the impact that will have on real yields as well. And in order for financial conditions to tighten, you've got to kind of see, I think, some repricing to some extent in terms of equities, particularly the longer duration, real yield growth sensitive equities, but also within credit as well. And I think actually the Fed is more likely to be responsive to credit conditions than they are to the S&P 500. So I'm pretty skeptical that there's a kind of Fed put on the S&P. I think there is a Fed put on credit, but that doesn't mean that credit spreads can't widen, quite meaningfully from here before the Fed starts to perhaps tone down its rhetoric or to adjust the sort of expected path of policy tightening.
David Riley, thank you, sir, as always, of Blue Bay Asset Management. And speaking of credit spreads, Lisa, I think we're still trading inside of the wides associated with Omicron at the start of December.
Yeah, honestly, it's been really under control, which is the point that we were hearing earlier, that basically this seems to support some of the stock resilience that you've seen. Honestly, how are you going to see a massive sell-off if credit is what leads? But I would flip this on its head. Why would the Fed get concerned about market reaction if the credit impulse was not disrupted? Are they really worried at a time where it does not seem like there's a lack of liquidity or something actually breaking in markets, or is this just normal turbulence that comes along with a policy shift?
Well, there's a difference then. I think you've brought up the right point. There's a difference between market functioning and market prices. and you're getting to the point about concerns over market functioning. I don't see anything like that happening right now. I don't hear much of that anyway. Market pricing, as I said, we're still trading inside the wides of a couple of months ago. They're not going to be too concerned about that. That's the pricing of markets at the moment, the functioning too. I'd say keep an eye on the data as well. A little bit later this morning, we'll have US PMIs. Eurozone PMIs today. This came from the chief business economist at IHS Markit. Perceived prospects have improved among manufacturers linked to fewer supply shortages, adding to the brightening outlook. Is supply about to kick in the other way, Tom, in a better way in the months to come?
Again, I go back to growth, and I've mentioned it 3 times. The Krugman essay laid this out now, the dynamics of demand and the dynamics of supply. If and when you get the supply bottlenecks straightened out, what does that fold over to demand? John, have you bought all the things you have to buy to front run your worries of supply into 2022? So then what does the demand look like in August?
I'm ready to go, Tom. Done all my purchases.
Yeah.
We're good. Do you know who's coming up next? Pierre Ferragut of New Street Research. What a fantastic analyst to catch up with, Tom, in a couple of minutes' time.
With technology this week.
Looking forward to that. Futures down 29 on the S&P, down 0.7%. Yields in a couple of basis points to 174 on 10s. And crude, 84.78 on WTI. From New York City, for our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden reportedly may drop the U.S.'s restrained stance on Russia and Ukraine. According to the New York Times, the president is considering deploying warships, aircraft, and several thousand troops to NATO allies in Eastern Europe and the Baltics. There's growing concern that Russia will attack Ukraine. British Prime Minister Boris Johnson faces his most crucial week in office. Johnson is bracing for the outcome of an investigation into reports that he allowed drinks parties in Downing Street which broke pandemic rules. The result of that probe could lead his Conservative Party colleagues to force him out. Blackstone Real Estate Income Trust is expanding its bet on U.S. rental housing. It's agreed to buy Resource REIT in a deal valued at $3.7 billion. The deal gives Blackstone a portfolio of 42 garden-style apartment communities totaling more than 12,600 units in 13 states. Shares of department store chain Kohl's are surging. The company is fielding interest from 2 potential buyers. Bloomberg's learned that latest offer comes from Sycamore Partners. It's unclear how much the private equity firm is willing to pay. Earlier, another bidder backed by hedge fund Starboard Value offered $9 billion for Kohl's. And an activist investor is adding to the pressure on Unilever CEO Alan Hope, who failed in his bid to buy a consumer health unit from GlaxoSmithKline. Bloomberg's learned that Nelson Peltz's Train Fund Management has built up a stake in Unilever. It's unclear what Peltz's intentions are. He has a history of